Welcome back. We continue our analysis of the South African Reserve Bank's latest interest rate decision. And of course, we do have Nikki Weimer, who's the chief economist at Nedbank, and Professor Peter Bauer, who is from the University of Johannesburg. Nikki, I want to pick up with you before I go to Peter. We were talking a little bit about some of the issues when it comes to growth in South Africa. And you also touched a little bit about the inflation dynamics that we're seeing locally. Perhaps you can educate us on the inflation dynamics that we're seeing in the ECB and that the Fed has also, to deal with versus South Africa's inflation.
Well, certainly, we are in a unique situation where South Africa's inflation rate is below that of the United States and below that of the United Kingdom and of the European Union, or the Eurozone, rather. So, interesting situation we find ourselves in. Now, of course, in America and in the United Kingdom and in Europe, the story of inflation is a little bit more complex. It's not as narrowly related to simply cost push pressure. It all started after the pandemic, where the moment they went into hard lockdown in 2020, of course, they went into stimulus mode. You had unprecedented fiscal stimulus. You had monetary authorities, the US Fed to the ECB, all of them basically slashing their interest rates to zero if it was not there already, and then essentially started to print money at the rate of knots. And quantitative easing during the pandemic was far broader than it was during the global financial crisis. And so you had all of this liquidity being pumped into the system. And the moment we got COVID under control, we learned to live with it a little bit better. Lockdown started to ease. What you had was this resurgence in demand. And very simply, the global manufacturing system, the global goods markets could just not cope with that. And as a result of it, with this lingering pandemic still affecting production, transport systems, logistics, you had this mismatch between demand and supply, and that resulted in a resurgence in inflation. And it really did escalate very, very rapidly. If you look at all of those countries, just from where it was at the end of 2020 to about where it was by the end of 2021. And then, of course, the other big factor there is that it started to translate increasingly into a very tight labor market. Now, that's something obviously we do not have in South Africa. They have an exceptionally tight labor market, and we know when you have a tight labor market, when there are shortages of labor, then that tends to push up wages. And now we've seen that in the US, we've seen that in the UK, and to a lesser extent in the Eurozone. But that is always a toxic combination. And one of the key criticisms against the Federal Reserve is that they've been asleep to some extent. They've been asleep at the wheel. They've been seeing inflation running away. They've been calling it temporary all this time. But in reality, the very thing the governor spoke about, where inflation starts to feed on itself, that spiral was already starting to set into motion, which is the so-called wage price spiral. So they've got a serious inflation problem. That's why they're moving more aggressively. And it is far more broad-based than just oil and food prices.
Right. Peter, let me come to you here. You had Moody's, forecasting a rise in inflation, probably for South Africa, sitting at around 8% for 2022. And then you have had other sort of market consensus, some saying 6.6% or rather 6.3% or 6.2%. Where is your inflation, expectations sitting at? And let's add in your growth expectations and how different that is it from where the SARB is seeing things?
I'm going to downplay the growth a little bit. There are a number of key factors there, and I think Nikki's already mentioned a number of key constraints there. In terms of the inflation, I expect it to be as well a little bit higher, though, predominantly because of the import pricing and obviously the commodities and what we are seeing in terms of the global oil prices, etc. So I'm a little concerned about import prices that are going to definitely be impacting us. So I would see us going over the upper target level, at least before midterm next year. What I'm also very, very concerned about is in terms of, shall we say, more stabilizing our economy on a number of different levels. again, I'm looking more on a social level. So I'm looking at small businesses. I'm looking at the level of poverty that we're experiencing in the country, and the very high youth unemployment that we're experiencing right now. There are large numbers of people leaving entering into the workforce or leaving school, and they are finding it very difficult. And that is going to put a lot more pressure on households in the moment. Households are struggling with where to put where to spend. The bucket of income is really tight for them, and so I'm concerned, at least within that sphere. Also, if we take a look at labor market, there is definitely upward pressure on wages. We're going to see a lot more upward pressure. We've now seen with SARS where they definitely are proposing wage increases, and we're going to see that across the industry, and that is driven a lot by household spending problems because of the high food prices and the high energy prices, which is obviously impacting everybody right now.
Let me stay with you, Peter, for this one. I mean, if we go back to last year, July, around about the time we had the July riots, I mean, a lot of what we saw was sort of infrastructure damage, which is sitting probably in the billions, especially when a lot of the companies report some of the damage they endured. But there were elements of what some would call a food riot, because we were starting to see images, especially here on the public broadcaster, where we were seeing images of people who were trying to get food, trying to get the basics. And then you start thinking of these elements of inflation and higher prices. And then I'm wondering whether you've thought about some of the low-hanging fruits or some of the easy ways we're able to alleviate the pressures for, people who are in the low-income areas. Some have suggested that perhaps bumping up the monthly child support grant. And I'm wondering, in terms of solutions, what have you been thinking about?
Well, in terms of social security grant, and especially, I think we're not high enough. We're not at that point where I think it is doing sufficient justice to households. I don't believe that we actually giving to society, to our local society, what we actually need to give. The additional support has to definitely come in terms of, shall we say, healthcare. We need additional support in terms of schooling. That is where I would like to put additional infrastructure expenditure, and also let's drive this expanded public works program that we have. Let's get funds out there. I'm not a big fan of reducing minimum wages or any of that, because I don't believe that the minimum wages do justice to the cost of living for many households out there, despite the fact that that can have an impact on industry and the cost of production. And obviously some people may consider it inflationary, which I'm not exactly in total agreement in that sense. But what I do see is that if we can provide additional support in terms of those infrastructural areas where households require that support, healthcare, social services, Nikki's mentioned them, improving life-sustaining goods, including electricity, access to water, and we have a large number of people living in informal settlements still, and these kind of conditions in which people are living is considerably unacceptable, and we need to address these concerns. And I believe by approaching it from an expenditure direction from that side, a social expenditure, I believe we'll be able to achieve a lot more.
We've got about a minute left, Nikki. Let me, wrap up the conversation with you. What should we be thinking about when it comes to accelerating or at least nudging growth for South Africa?
Oh, yes. I mean, we have to look at all the things that have been mentioned, but I think the key thing here is we need to lift the electricity constraint. I mean, that is becoming absolutely urgent. It's been urgent for 10 years, but it's now even more urgent. So I think then we need to be innovative. We know the renewable energy program works. Maybe there are ways that we can extend that, can accelerate that, step up that process. So certainly the energy constraint, the electricity constraint is a major deterrent to growth. And then I think the other thing that we need to spend attention on is other forms of infrastructure, road, rail, port infrastructure. If you speak to exporters, then very often it is not just electricity that pops up as a major complaint, but it is also the other forms of infrastructure, particularly backlogs at the ports, and the fact that we have the wrong mix of road and rail. So you can get into all of these micro elements, but it's essentially infrastructure. But having said that, though, if we're going to go that route, if we're going to accelerate infrastructure spending, it's got to actually deliver quality assets. For 10 years, we spent on Medupi and Kusile, and it did not deliver quality assets. It's got to actually lift the infrastructure constraints. It's got to be efficient spending. And I think that's a key point. And then the other point is, I think, to create a far more predictable and a stable regulatory and legislative environment.
Yeah.
And having said that, all of the things I'm mentioning now, government is very well aware of. Many of these ills have been diagnosed decades ago.
Right.
So we know what the problem is. I think our challenge is to actually implement those steps.
All right, Nikki, let's leave it there. Thank you so much for your time. That is Nikki Vaimo, the chief economist at Nedbank. She wasn't alone, joined there by Professor Peter Bauer, who is the economics professor at the University of Johannesburg. Thank you so much for joining us. We're going to leave it there. And of course, we'll continue with the rest of the